Good morning, everyone. Mike and Corey here today. Had a rough market yesterday, seeing some rebounds early today. We'll see where that continues. I'm going to talk about real quick, like with this volatility, with the market that's down, we're starting to see some company changes, whether that's a CEO or that's major company policies. I'm just going to cover a few that I've seen just today. And then Corey's going to talk about the very important aspect of dollar cost averaging, which certainly when markets go down, that's where you really like to see, oh yeah, that's why we do dollar cost averaging and continuous additions to your portfolio. So let me say, this is a financial education presentation. You must do your own due diligence on anything in this presentation. More information, disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So, after yesterday's red day, I'm pulling up the markets here, and you still see some red, and it's been bouncing around from green to red and back and forth. S&P's just down a little bit. NASDAQ's up 0.44 and Bitcoin is up 2.5%. So some good news there that we're starting to see hopefully a bottom to this. And then we'll start to see, of course, we all hope a rebound upwards. So, during these times of volatility and concern, I guess I've noticed this is when times when companies start to change things out, whether they want to do it or they're forced to by the market, but it's time to get shareholder expectations met. So here, I'm going to show you a couple things that came up, and a lot of times, people are like, oh boy, wouldn't it be great to be the CEO of a company, mainly for the pay. I don't think anybody really wants the stress, but a good company called Asana, their CEO retired and their stock dropped 25% today. Actually, it's down 27%. The CEO was one of Dustin Moskovitz was one of the original co-founders of Facebook, and he hopped over to Asana. And I'm just going to show you, a chart. And this is what I would call CEO pressure. So of Asana, there you go. When they come out, they had a big surge up in 2021 and then followed by blah, yuck. And now the CEO retired, the stock went down further. Is Dustin wealthy? I'm sure he is. I'm sure he's cashed in plenty, but that's the stress, and that CEO's out. Another one, Nissan, Makoto Uchida to step down on April 1st. Now, whether, this is due to performance, but this will be Nissan's fourth CEO in 8 years. So a lot of times people say, oh, it's good to be the CEO. Well, let's see, every 2 years on average, it changes. A lot of pressure. And it said this came, Nissan and Honda were talking about mergers and that fell through. And now this guy, whether he's retiring to spend time with his family or whatever, he's out. And then the last, these two, you might be like, those don't affect me. I don't own those stocks. Neither do we in our models. This next one does affect you. Southwest Airlines changing to start charging for checked bags. And it's kind of interesting because most airline companies, there's a variety. The Deltas and Americans, I think they allow you one checked bag for free. If you're Frontier or Spirit, you're going to pay for every single thing that you check, from even a carry-on. And Southwest was by far the most friendliest, allowing 2 checked bags for free. They're starting to change that. I know it's a graduated model depending on if you're a, A+ member of Southwest. But Southwest is actually getting driven by Elliott Investment Management, who's taken up a position in the company. And I think they have a couple board members now. So these are like activist investors. And they're saying, you got to make some money. You got to make money. And look at the move in the stock on adding airline baggage checks on a market that's barely up today at all. Southwest is up 9%. So, who'd have guessed, charge for bags, stock goes up almost 10%. So it's just interesting what happens in a market that's declined. When everything's going up, it feels like, oh yeah, we're doing great. We don't need a lot of changes. But when things go down, we start to see this. So talk about when things go down. Let me turn over to Corey and he'll talk about dollar cost averaging and how it actually is your benefit when things go down.
Yeah, absolutely. And I'm probably not the only one who's had this quote on my mind the past few days. Have you ever heard this, Mike? The stock market is the only market where things go on sale and all the customers run out of the store. Are you familiar with that one?
I haven't heard that exact quote, but it's the same thing as when, and I just pick on NVIDIA because that's such a hot stock over the last year. When NVIDIA went up to $150 a share, people were, they couldn't wait to get it. Like I got to buy it. I got to have that in my portfolio. And then when it's dipped down to closer to 100, which is kind of where we actually entered some of it at about 100, people, and then you reach out to that same person, hey, it's down to 100. It's on sale. It's on sale. You want to buy it now? Nothing's changed. I mean, the CEO is still the same, still good earnings, and people are like, let me wait. I'm not really sure. I don't know if they've run out of the store. They're like at least waiting to see, like, do people still really want this? So it's definitely true.
Yeah, and so I guess you could say that that's some people's strategy, right? Is maybe let's panic, let's run out of the store, and I don't know, get scared. Well, that's not going to be to your benefit as an investor. I'm going to run through a couple of scenarios, and I want to give Mike's Financial Edge credit for the scenarios from YouTube. So it's his scenarios, but really interesting how if you just look at those three charts, so you got three charts there, three different stocks, and you say, which stock would you want to own the most? Just looking at the chart, which one do you think most people would pick, Mike?
Oh, of course they pick the top one. They say
The top one,
that's
yes.
going right up. I love it.
I want my stock to go straight up. Well, take a sneak peek at the end math here. That's actually not going to be the best stock for you to dollar cost average and buy over time. So the concept of dollar cost averaging is I'm going to work, and I mentioned this yesterday, I'm going to work, I'm doing my job, I'm getting my paycheck, my income is greater than my expenses every month. I'm saving money, I'm deploying capital, investing that capital, and I'm buying whatever number of shares or whatever quantity of assets I can every month with that excess income I have above my expenses. So in the case of stock number one, you're deploying, however many hundreds of dollars each month, and you're acquiring shares. So in that first month, the stock price is low. You can buy 12 shares, and then it goes up and you're happy, I guess, but that time you can only buy 8 shares. And then it stays flat. You can only buy 8 shares. Then it goes up. And I guess you're happy, but then you can only buy 6. And then a couple months later, it goes up again. And I guess you feel happy again, but then you can only buy 5. So as this stock is going up, you sort of think that you're feeling really good, but what's really happening is your purchasing power is decreasing like every month. Let's look at the stock number 2. Oh, and in every scenario, they've deployed the same amount of money. In scenario 1, you can see this investor was only able to get 62 shares because the stock price was just going up. And maybe they felt happy, but it really wasn't in their absolute best interest, especially for someone who's 30, 40, 50, who's multiple years, maybe even a decade away from retirement. And in those scenarios, the overall goal is we want to acquire as many high quality assets as we possibly can. And the best way to do that is for the prices to stay stable or maybe even sometimes go down so we can buy more, than our purchasing power gets stronger. Okay, in scenario 2, this stock doubled quickly. Maybe the investor's feeling good, and then it crashed. It fell actually 75%. And the investor might have felt sad, but they weren't deterred. And because they weren't deterred, their purchasing power actually allowed them to buy 24 shares for 3 separate, payment periods or purchasing periods, which really exploded the number of shares they had as the economy or that stock or industry rebounded. Again, not everything rebounds, but high quality assets do. As that rebound happened, the investor was actually, they actually were more rich or more better off than they were in the original scenario because of the dip. And then in the last scenario, you see another similar thing play out where the stock never really goes up until the end of this cycle. But because the investors stuck with it, they didn't give up after month 1 or 2 or 3. They benefited by adding higher quantity of shares at lower prices, so that when the appreciation kicked back in, they actually did just as well as the stock that went straight up. So dollar cost averaging through weakness is actually kind of a superpower that we have as investors. So, it can feel a little painful. We talked yesterday, you get that high water mark. Yay, my portfolio hit blah, blah, blah amount. But now it's 10 or 15% below that. I'm sad maybe. Well, you shouldn't be, because what you're really doing, you're purchasing at lower amounts. You're purchasing higher quantities of shares. And when that rebound does come into play, you've actually created a coiled spring in your portfolio that will bounce higher, faster above that last high watermark whenever that is. But the longer it stays low, the more coiled that spring gets, because you're acquiring higher quantity of shares. Sorry to go a little long on that,
No,
but it's really
it's
important.
It's really good, because if you look at that chart, certainly chart 1 and 2 there, it is, and I'm going to say it takes courage on that second one. So
Absolutely.
that's the tough part. So if you bought something that was at $40 a share and it drops to 10, and you see red numbers on your cost basis, you're like, I'm down. It takes courage to buy more. And I mean, I just say it does. And there's a lot of times when things drop, you're like, oh, I hate to buy more, it's down. Whereas the top one, it doesn't take as much courage when you see green numbers in your cost basis, and you're like, hey, I'm up $200, so I'll buy a little bit more and I'll be up another 200. So I'd say that's the biggest difference. Mathematically, it all makes sense, but psychologically, that is a tough decision right there. So
And
anyways,
where we come in, in helping with this process is, there are some stocks that don't come back, or maybe it takes them multiple years more than the market to come back. We've seen that over time, of course. Palantir could be going through something kind of like that right now. We'll see. But it's our job to help you find those high quality assets. One that's in my mind these days is an Amazon. Amazon has been really punished in this cycle, and it is objectively one of the highest quality businesses in the world. So it's up to us. We're identifying the high quality assets that will absolutely return back to highs as the market allows that to happen. So high quality
fantastic.
assets is the top priority.
Awesome. Thank you. Thanks, everybody. And, right now the market's in the red, or it's been in the red for the last couple of weeks. Overall, when you look at overall stock market, S&P down not quite 10%, the NASDAQ over 10%. So in Corey's example of stocks, we're looking at the overall market. And, that's certainly not a huge drop by any means. You've seen that happen many years. So we will continue to monitor that, make adjustments as needed within our different models. Thanks, everybody. Have a good one. Bye.